In 2019, a woman named Amanda walked into a car dealership with a 780 credit score. That's considered excellent. Top tier. The kind of number personal finance influencers tell you to obsess over. She got rejected. Not because of her income. Not because of her job. Not because she had any debt she couldn't handle. She got rejected because she had too many credit cards with zero balances. Her score was almost perfect, and it still didn't matter. Today I'm going to show you exactly why that happened, and why almost everything you've been told about credit scores is either incomplete, misleading, or just flat out wrong. And before we're done, I'll show you the number lenders actually care about. Spoiler, it's not the one on your phone. Here's the first thing nobody tells you. There is no single credit score. Right now, you have dozens of credit scores, and they're all different. FICO alone has 28 different versions of your score. There's FICO 8, FICO 9, FICO Auto Score 8, FICO Bank Card Score 9, FICO Mortgage Score. Vantage Score has its own system. So does each individual bank that has its own internal scoring model. The score on Credit Karma? That's a Vantage Score 3.0, which almost no mortgage lender uses. In fact, when you apply for a home loan, 90% of mortgage lenders pull a score called FICO 2. That model is so old, it was built in the 1990s. The same decade as dial-up internet. So every time you've optimized your score on an app, you may have been playing a completely different game than the lender you're trying to impress. This isn't a small technicality. This is the foundation. Take Marcus. A real case from a Reddit finance thread. He spent 2 years raising his Credit Karma score from 680 to 740, closed some old accounts, opened a new secured card, paid everything perfectly. He applied for a mortgage. His FICO 2 score, the one the lender pulled, was 694. All that work, and the number the bank saw barely moved. So if the score on your phone isn't the real score, what is? And who decides? That's where things get dark. Before 1989, there was no universal credit score. Lenders used whatever they wanted, their own gut feeling, your neighborhood, your race, your name. Yes, literally. Redlining was legal. Banks rejected loans based on zip codes because those zip codes had mostly black residents. The FICO score was introduced partly to fix that, to create an objective, race-neutral number. And in that sense, it was a genuine improvement. But here's what nobody talks about. FICO is not a government agency. It's not regulated like one. It's a private company, Fair Isaac Corporation, and it sells your score to lenders. The credit bureaus, Equifax, Experian, TransUnion, are also private companies. They make money selling your data. You are not their customer. You are their product. And the data they collect has errors. Big ones? A 2021 study by the Consumer Financial Protection Bureau found that 1 in 5 Americans had a material error on at least one of their credit reports. Think about that. 20% of people are being scored, and potentially paying higher interest rates or getting denied, based on information that isn't even accurate. One real case. A man named Robert in Ohio found a $24,000 medical debt on his credit report. He never received that bill. A collections agency had the wrong person. It took him 18 months and a federal complaint to get it removed. During that time, he was denied a car loan and paid extra on his insurance. That's the system you're trusting with your financial future. So let's talk about what's actually inside your score, because this is where most people make the worst mistakes. You've probably seen the FICO breakdown before. 35% payment history. 30% amounts owed, credit utilization. 15% length of credit history. 10% credit mix. 5% new credit inquiries. Looks clean. Logical. Easy to game. Except that breakdown is from the publicly published FICO algorithm. FICO has never fully disclosed the actual formula. Those percentages are approximations. The real weight of each factor shifts depending on your entire credit profile. Someone with no late payments and someone with 3 missed payments 2 years ago will see those factors scored completely differently. The model is dynamic, not fixed. But here's the myth that costs people the most money: credit utilization. Everyone gets told to keep utilization below 30%. Some say 10%. Influencers talk about it like it's carved in stone. Here's what they don't tell you: utilization has no memory. It resets every month when your statement cuts. That means you can go from 85% utilization to 3% utilization in a single billing cycle, and your score jumps significantly. And it means that keeping your utilization artificially low for years only helped you during those exact months. Real example. A woman named Priya in California followed every rule. She kept her utilization at 9%, never missed a payment, had 5 years of credit history. She applied for a personal loan to consolidate some debt. The lender looked at her debt-to-income ratio, not her credit score, and denied her because her monthly debt obligations were too high relative to her salary. Her 760 score meant nothing in that specific context. And that brings us to the most important thing I'm going to tell you today. Lenders don't see what you see. When a bank pulls your file, they get what's called a tri-merge report, all 3 bureau reports combined, plus your score. But that's just the starting point. For a mortgage, lenders go through what's called manual underwriting. They look at debt-to-income ratio, your total monthly debt payments divided by gross monthly income. Most lenders want this below 43%. Some cap it at 36%. Loan-to-value ratio, how much you're borrowing versus what the asset is worth. Reserves, how many months of payments you could cover with savings after closing. Employment stability, 2 years with the same employer or in the same industry is the standard. Payment pattern, not just whether you paid on time, but the pattern. Sporadic late payments that got better look different than a one-time miss from 3 years ago. Here's something that shocks people. A person with a 680 score and a 30% debt-to-income ratio will often get a better mortgage rate than someone with a 740 score and a 48% debt-to-income ratio. The number on the app tells you almost nothing about how a specific lender will treat your specific application. And it goes further. Auto lenders use FICO Auto Score, a version specifically calibrated for car loans. It weighs your history of auto payments more heavily. If you've never had a car loan before, that score can be dramatically lower than your general FICO score. Credit card companies use FICO bank card scores. If you've ever had a credit card sent to collections, even once, even 7 years ago, and almost off your report, certain bank card models still penalize you heavily. The point isn't that credit scores don't matter. They do. But they're one piece of a puzzle most people never see the rest of. And chasing that number while ignoring the rest of the picture is like training for the bench press when you're being tested on a sprint. Let me show you what that looks like in real life. Mistake number 1. Closing old credit cards to clean up your profile. James had 4 credit cards. He used 2 of them regularly, and the other 2 he hadn't touched in years. He closed them to simplify his wallet. His score dropped 40 points in a month. Why? 2 reasons. His average age of accounts dropped, and his total available credit went down, which raised his utilization ratio even though he didn't spend $1 more. He was paying for a decision that felt responsible but was financially penalizing. The rule: almost never close old accounts. Even if you don't use them, they're helping your score. The only exception is if they have a fee you're not getting value from, and even then, try to downgrade the card to a no-fee version first. Mistake number 2. Applying for every store card that offers 20% off. Every hard inquiry drops your score 3 to 7 points and stays on your report for 2 years. Open 4 store cards in a year and you've taken a hit, added to your new accounts metric, and lowered your average account age. For 20% off a jacket. Mistake number 3. Paying off a collection account without negotiating. This one is counterintuitive. Paying an old collection account can actually hurt you temporarily. Here's why. Collection agencies sometimes re-report the account as recently active when payment is received, which resets the clock on when it appears negative. The strategy is called pay for delete. You negotiate with the collector to remove the account from your report entirely in exchange for payment, before you send a single dollar. Get it in writing. This isn't widely advertised because it's not in the Bureau's interest. Okay. So if the score is just one piece of the puzzle, what do you actually focus on? First, pull your actual credit reports. Not your score. Go to annualcreditreport.com, that's the federally mandated free site. Pull all 3 reports. Read them line by line. Dispute every error. 1 in 5 people has a material error. Check if it's you. Second, stop checking your score monthly. Start watching your report quarterly. Your score will follow if your report is clean. Obsessing over point swings week to week adds anxiety and changes almost nothing. Third, build your full financial picture, not just your credit picture. That means lowering your debt-to-income ratio, the thing that actually gates mortgage approval for most people. It means building 6 months of reserves. It means stabilizing your income source. The credit score is the entrance exam. The rest of your finances are the course. Fourth, if you're going to apply for a major loan in the next 12 months, freeze your credit now. A credit freeze is free at all 3 bureaus. It prevents anyone from opening new accounts in your name, including you accidentally hurting yourself with a soft pull turning hard. You unfreeze it when you're ready to apply. This also protects against identity theft, which is the most common reason for errors on reports. And fifth, understand the timeline. Late payments fall off after 7 years. Bankruptcies after 7 to 10 depending on type. Collections after 7. Negative items lose scoring power significantly after 2 years, even before they fall off. Time is the most powerful credit building tool that exists. Better than any credit hack you'll find in a YouTube short. The credit score system was built to serve lenders, not you. That doesn't mean it's your enemy. But it means the rules were written from a lender's perspective. Once you understand that, you stop playing defense and start using the system the way people who actually understand it do. Amanda, the woman from the beginning, went back 6 months later. She hadn't touched her credit score. But she'd paid down a personal loan that was driving up her debt-to-income ratio. She had 3 extra months of savings sitting in her account. She'd been at the same employer for 2.5 years. Same credit score. Different financial picture. Approved. The score didn't change. Her eligibility did. That's the difference between chasing a number and building actual financial health. If this changed how you think about credit, share it with someone who's still obsessing over their credit karma score every week. They need to see this. And if you want part 2, where I break down exactly how to dispute credit report errors step by step, comment errors below and I'll make it. See you in the next one.